Firstly, good afternoon or good morning, depending on where you are based, of course, in the world. I know we do have people that sign on from various jurisdictions. For those of you that are joining the webinar and don't know who I am Block Asset Management co-founder Kevin Ballard, and I am the CCO for the group. And I'm joined today by my colleague Yanis Georgiandelis. Would you like to introduce yourself, Yanis?
Sure, and nice to be here. I'm BAM's Chief Investment Officer. I'm responsible for the market research, the fund selection process, preparing the investment committee.
Excellent. Thank you very much. So basically, for those that are not familiar with Block Asset Management, I think it's best that I give a very brief introduction as to who we are. And Block Asset Management are a Luxembourg specialist AIFM in the digital asset space. And we manage the world's first blockchain and digital assets fund of funds, which now has a 7-year track record. In essence, we act as an institutional grade risk filter for the digital asset space. We currently have a database of around 12 to 1,300 digital asset funds, which we are slowly working through to ensure that we identify and allocate to the best in class managers in the digital asset space. So with that introduction made, Yanis, can I hand over to yourself to provide a brief market review and a look at the current macro environment that we are finding ourselves in?
Sure, let's get started. I think that this year has been, once again, an amazing year for Bitcoin. Did you know, Kev, that in the last 13 years, Bitcoin beat all the other asset classes 11 times? So it's no surprise to see, once again, Bitcoin achieving a nice return, plus 50% year to date, followed by gold, around 30%, and then US equities and European equities. Interestingly, you will note, Kev, that Bitcoin and gold, which are alternative investments, actually delivered the best returns. So probably it makes sense to diversify in alternative investments in a portfolio context because it's really a risk return enhancer. Now, if Zoom allows me to, pass to the next slide. We had a terrific first quarter, as you remember, Kev. But it is also true that then we went through a 6 months consolidation period with essentially Bitcoin's trading sideways, but the remainder of the market, that is to say Ethereum, DeFi, the mid to smaller cap tokens, experiencing a mid-cycle consolidation, sharp correction down to even a minus 20, 30%. And there are many reasons for this, but one of the reasons is, as you know, concerns over potential U.S. economic recession, because in this case, you don't want to invest in risk on assets, and therefore, because of this risk, you had this all the digital assets except Bitcoin being sold. But let me be clear. There's, if I can pause the slide. All right. So I have a bit of technical issues with Zoom. So we're not going to get into a big macro conversations, and we could share tens of charts. But I think if we had to take one chart, I would take this one just to make the case for there's no reason there would be no recession, essentially. In other words, in the US next year, you take the jobless claims. They are currently in the very low end of their historical range. And as you can see, usually when you enter a recession, you can notice a sharp increase in jobless claims. Those are the red areas which are highlighted in the chart. So as long as prove the contrary, current conditions just do not support the view that the economy is getting very weak. And therefore, there's no reason to be overly pessimistic about a US economic recession. Yes, the leading indicators have been weak, but the coincident indicators about the current economic activity have been just fine. So based on this chart, which I think is very valuable, there's no reason to believe that there will be an economic recession in the US next year. The other main concern is, of course, the inflation rate in the US. It's one of the reasons why we entered the bear market 2 years ago. Good news, inflation is not a problem anymore in the US. We reverted to the 1 to 3% historical range, 2.4% as of end of September. It's the lowest figure since February 2021. And it's so important because it means that essentially the tightening period from the Fed is over. And actually, we're reverting to a more accommodative policy because inflation is going down. So it's really good news. And it's really good news because, as you can see on the chart, the correlation between global liquidity, we use a proxy, which is M2, the monetary supply for the main economies, US, EU, UK, China, and Japan. As you can see, the blue line representing the global liquidity correlates very well with the evolution of the total market cap for digital assets. So there is a strong historical correlation. So you can see during the green areas, in the green areas, when liquidity is going up, essentially digital assets are going up. So it's been the case since end of 2023. And again, this year, we resumed a period of increased liquidity. But as you can notice on the chart, there's a discrepancy. Prices didn't go up except for Bitcoin. So hopefully there should be a reconnect of prices with the increased liquidity at some point in the future. So this is quite bullish. Of course, we cannot avoid the discussion on the US elections, and cryptos have become a hot topic for one single reason. The swing states are very much interested in crypto. So you have to be bullish on crypto and pro crypto if you want to win the elections. The swing states are highlighted in green. And I mean, whether it's Trump or Kamala Harris winning the election, it doesn't matter. It's a win for cryptos, essentially. We're going to have pro-crypto policies. We're going to have pro-crypto regulations. We already have a regulation in the EU. This was missing in the US. As we remember, all the SEC issues, sending, notices to some blockchain protocols. I mean, a lot of concerns in terms of regulatory issues. All this is going to disappear. We're already, actually, as a matter of fact, we already see some bills being passed in the US, and you can expect a lot of pro-crypto regulations in the US next year. And of course, if Trump wins the election, I cannot see Trump and his family being involved with WEF in DeFi and having a partnership with Aave, shooting themselves in the foot. So I believe that if Trump wins the elections, it would be very bullish. But if Kamala Harris wins the election, it would be bullish too.
Okay, I'm not sure how many of the audience actually saw on that as well. That just last week, Standard Chartered announced that if Trump was to win the election, which I think currently the swing is, I think, 62-38 in his favor on the polls. But if Trump is elected, they will up their Bitcoin year-end target to $125,000. So, it's very positive for the digital asset class. So, and we know the correlation historically. The elections typically are preceded by a bullish sentiment in the market, which I'm sure we'll touch on further down the line as well. And Yanis, I'm sure most of the audience are on our distribution list, and those that aren't, if you'd like to be on, please drop us a communication after the webinar. But those that are on the distribution list, you'll have received a circulation that we put out with our August fact sheet, which was sent out in mid-September. And the article that we sent out was entitled The Case for the Imminent Bull Market. So can you explain, Yanis, the reasons behind our confidence, which dated back a couple of months, and why we truly believe that the time to invest is now?
Sure, Kev. I think it's one of the key reasons why it has a lot to do with where we are in the cycle. And as you can see on this chart, we just experienced a mid-cycle consolidation. And this is the reason why we could see some down months recently for the fund, but it's very normal. Looking at the previous cycles, you can see that 2012, 2016, life cycle 2020, we had a first, let's say, uptrend, followed by the typical consolidation and then we experience a major rally. So we're typically entering the best part of the cycle when you can expect, based on the previous cycles, an acceleration to the upside. The other reason is we're in Bitcoin's post-halving year, and we know that during those years, in Q4, all months have been historically positive. 100% have been positive. 2012 couldn't be shown on this table. It's coming from CoinGlass, but essentially we had only positive months in Q4 during those specific years. And seasonality, of course, Q4 and Q1 are typically the best periods to be investing in digital assets. And finally, yes, indeed, the US presidential cycle. Typically, you can see after each US election, it doesn't matter if it's a Republican or a Democrat, but over the next 52 weeks or 12 months, 12 to 15 months on average, you can expect risk on assets to rally, including digital assets. Therefore, Kev, maybe if you want to.
If I just cover, really, it's just if we just go through a bit of a summary, really, on how the macro headwinds of the past couple of years, this year really turned the corner into tailwinds. Positive factors for digital assets. Yes, you've touched on the US election, so the crypto market has historically rallied post-election, as we've seen on the previous graph. Global rate cuts from the Fed and the ECB. We've already seen the rate cuts have a positive impact on the market, with further rate cuts expected in the coming months and into next year. This will only prove to be positive for digital assets. Economic stimulus in China, of course, stimulus in any region is always good for the markets, and certainly the case for digital assets and for risk-on assets. And the Bitcoin and Ethereum ETFs, whilst the Ethereum ETF wasn't the initial huge success that the Bitcoin ETFs were, it was more of a slow burn, but we are now starting to see an accelerating of inflows into the ETFs, both Bitcoin and the Ethereum ETFs, which is ultimately good for the market. And then the final point is whales accumulating. And when we say the whales, for those of you that aren't familiar with the term, it is the big players in the space, the wallets that have typically, a large sum of digital assets, typically Bitcoin, but any real wallet that has a huge value in crypto assets in it. They tend to be quite dormant, and the whales tend to just add and build up their reserves just before a market rally. And certainly all signs and indications are showing that numerous whale wallets are picking up now and adding to those wallets that have previously been kind of dormant for some time. So there's a good indication of the market is due to rally. Yanis, let me play devil's advocate here. Okay, so with the launch of Bitcoin ETFs in January, with Bitcoin halving in April, 2024 has definitely been Bitcoin's year. The question for many, and the question that I get from some investors, is, should I invest in Bitcoin or should I take a more diversified approach? So given where we are in the market going into Q4, what's your view on that? Should investors look to take a position on Bitcoin only, or should we take a more diversified approach?
I think it's a fair point, and I will answer your question sharing this chart. When you look at the discrepancy between Bitcoin's return in the last 2 years and a half and the broader market, you already realize that the bulk of the gains have been already achieved by Bitcoin. It doesn't mean that the Bitcoin cannot go higher, but there was already a huge rally. We have not even started for the broader market. So there is a big catch-up effect to be expected from the broader market, but we've been there in the past. I mean, it's not the first time that the broader market altcoins lag behind Bitcoin. It was the case during the life cycle, and it's a pattern we tend to see. And usually there is it's been frustrating for investors being diversified, for sure. It's been frustrating because Bitcoin has been the best performer, and then obviously the rationale is why bothering with diversification is not rewarding, but actually it is. It's just that it's not all the time. And if you look at the last cycle, yes, after the first 2 years, then we had totally the opposite. We had actually the broader market. We used the MarketX top 10 as a proxy for the broader market. So that's the purple line. Did actually had a stellar performance, achieving 3 times Bitcoin's performance. So there's no truth in believing that Bitcoin is always the winner. Bitcoin is sometimes the winner, and some other times it's the broader market. And we just believe actually that we're at the very moment when the broader market is going to do a lot better than Bitcoin, and it's not just 10% more. You can see the discrepancy. It's 3 times the performance of Bitcoin. And one of the rationales and the reason why at the state of the cycle altcoins are going to do much better is fundamentals, not hype. Fundamentals. If you look at the state of crypto index, which is an amazing index which puts together all fundamental data, like things which really count in the long run, like the number of active addresses, transaction fees, volumes, total value locked, fundamental metrics, which give you an idea as to if this sector is growing or not. As you can see, the state for crypto index has risen a lot, but on the other hand, altcoins, they've had this consolidation. So we find this as an anomaly, a short-term anomaly. As you can see, there is a strong correlation between long-term fundamentals and the evolution of the broader market valuation. So based on the current valuations, around $200 billion, and based on the improved fundamentals that the overall sector had this year, we should be 4 to 5 times much higher. So it's not a trading indicator, but we know that there is a lot of catch-up to be expected from this sector based on the fundamentals that have still not been reflected in prices. The other reason is that is Bitcoin's dominance. As you know, Bitcoin's dominance is Bitcoin's weight relative to the market, to the remainder of the market. So we've reached the 59 to 60% dominance level, which has been historically a very strong resistance. In other words, Bitcoin has been rarely above this level, and it's not only the level; it's also the time and the moment. So Bitcoin has been indeed outperforming the rest of the markets, and this is why the Bitcoin's dominance has been picking up, increasing to 59%, 60% now. But now we are just entering the green area, which is when typically Bitcoin's dominance starts to decline, and this is associated with a broader market expansion out seasons. So we are really not only in terms of level, but in terms of where we are in the cycle, entering really the sweet spot of our strategy. This is another way to look at this. Bitcoin's post-halving cycles. You can see in the 3 previous halvings that the red line representing the MarketX Bitcoin has really expanded a lot faster than Bitcoin, and it was typically when Bitcoin was managing to revert to its previous all-time highs, experiencing new all-time highs, and this is where we have the confidence for investors to invest in altcoins and the broader market. And then typically, so this is why we believe that as long as proved the contrary, it would be a mistake actually to not be investing in the broader market at this stage of the cycle. Technically, it's also quite interesting to see that we've been on a buy signal. We remained on a buy signal despite the 6 month consolidation, and we're starting to see bullish reversals. And we're currently exiting the downward trend. It's very bullish. It needs to be confirmed, but this is typically when you'll start to experience higher highs and higher lows, and this is very healthy, and it bodes well for the coming weeks. As a matter of fact, you already start to see some less known but altcoins from the broader market, uh, uh, breaking that downward trend to the upside, exiting and showing strengths. And you can see their market cap, number 9, Tron, or AVEX, number 12. But it's not only the biggest cap, it's really the broader market. As you can see, you can find the smaller caps in which, by the way, all funds invest. Not necessarily those ones, because it's not a recommendation to buy those tokens, but it's just an illustration that behind the scenes, there's a lot of positive activity going on. The technicals are improving, and every day I can see new tokens breaking out. So it's very positive, and this is going to pave the way for a broader market expansion. It's not based on a limited number of tokens. It's really started to spread towards the lower end of the market, the smaller caps, which are going to increase in value much more, because it's a lot easier to move $100 million or $200 million dollars market cap than a 50 billion or let alone a $1,100 billion market cap.
Couldn't agree more. In fact, these breakouts are great examples of how selective research-driven exposure to altcoins can provide great outperformance in a portfolio. I mean, just this morning, probably an hour ago, I managed to jump online and just quickly check on CoinMarketCap as to which tokens in the top 60, 70 by market cap had outperformed Bitcoin year to date. So whilst one of my previous questions was about the Bitcoin narrative and everything seems to be about Bitcoin this year, it's interesting and worthwhile noting when we talk about diversification that the following tokens have all outperformed Bitcoin year to date. And this is not an exhaustive list. So we've got Binance Coin, Solana, Toncoin, Sui, Bitensa, and of course, almost every meme coin you can think of at the moment, which is a call for another day to address meme coins. It's not something that we have exposure to, but certainly your Binance, Solana, Toncoin, Sui, Bitensa, these are projects that really have legs, and any team with the right research team behind them and the funds that we allocate to can certainly see that these projects have legs, and that these projects are the reason behind why they've ran. So definitely, if you have selective research-driven exposure to the best tokens in the broader market, you can gain outperformance. But what that does, Yannis, it leads me on to another question I want you to solve, or a misconception, should I say, that I want you to correct for us. So basically, the common misconception about digital assets is that they have no intrinsic value. We've all heard the various people that are naysayers on the digital asset class who will tell you, from Jamie Dimon and the like, that there's no intrinsic value. They're all pump and dump schemes. They'll all go to zero, and there's no value or income generated. So I'd like you to discuss why that is wrong. What is the intrinsic value in the ecosystem?
Yeah, thanks, Kev, for this question. I think it's I think when you look at I think investors, people need to understand that essentially altcoins, blockchains, those protocols have a business model which is very simple. They collect a fee for transactions which are going through the blockchains, and the higher the fee, the higher the revenue, the higher the value, and the higher the price. As simple as that. So the point here is just to recognize the fact that you need an increasing number of transactions for blockchains to be successful and be richly valued. And when you look at the KPIs in the sector, there are tens, but we've just selected two which are so important. The transactions. You look at the growth that we experienced in the last 12 months, plus 50%. If you plus 50% monthly transactions in 2024, this is obviously a very strong parameter to actually justify higher valuation. So, and you can see compared to 4 years ago, it's an exponential growth. So we can see a very healthy pickup in monthly transactions, And this is coming from also the fact that you have a much higher number of active addresses. And, uh, and therefore, based on those fundamentals, it's totally justified to have much higher valuations, because going forward, fees are going to be much higher. And in the DeFi sector, decentralized finance, as you can see, the TVL, total value locked, which is explained in simple words, it's the assets that the blockchains are able to collect because people want to use them, is also a good indicator of profitability, of forward profitability. Why that? Because the fees are based on the percentage fees on those assets, and the higher the TVL, the higher the potential to increase your fees. And as you can see, with the various subsectors being mentioned, liquid staking, lending, taxes, etc., the TVL has increased greatly and is almost back to the previous cycle high. So it's an indication that profitability is going to be even higher in the coming months. And as a matter of fact, you can see that the total monthly fees for the DeFi sector, they did not only increase, but they increased to a level which is equivalent to the previous cycle high, $4.5 billion generated in the last 12 months. And if you compare this amount of fees with the current market cap, which is only $71 billion, it's a no-brainer. I mean, it's a bargain in the sense that in the last cycle, for the same level of fees being generated by the sector, the market cap was $180 billion. So as you can see, only reverting to the same ratio would give you a 2.5x return. Another example, liquid staking. Liquid staking is a sector where blockchains allow investors to receive an income thanks to the staking of their token. You can see that the TVL, total value locked, in other words, the assets collected by those blockchains, they skyrocketed. I mean, $44 billion. And you can see the growth, amazing growth. Their leader, Lido, the number one in the sector, has collected almost 1 billion fees in the last 12 months. And in the lending sector, Aave, with whom maybe not for no reasons, the Trump family has a partnership with their new venture, has achieved $320 million in fees in the last 12 months. And if you look at for Aave, for example, it's not a recommendation, but just to give an idea as to how big the potential is for some tokens and how underestimated it is from investors at the moment. The cumulated fees generated by this protocol, this token, $1 billion, and since inception, and it's not 10 years ago, it's 3 years ago, and this total amount of $1 billion of fees having been collected historically is equivalent to 40% of the current fully diluted valuation. So you can see that a lot of value was created, and for different reasons, it was not yet recognized by the market.
I was going to ask, what's
Yeah.
that impact been on the performance wise? So, okay.
The performance has been so-so in a sense that the recovery did not reflect the improvement in fundamentals. I mean, it's consistent with the other charts we share, and therefore, when you look at the chart, the trend is turning up. You can see that we're exiting the reaccumulation area, which is the yellow area, and at the current levels, I mean, the potential to even revert to the previous cycle high, not even experiencing new highs.
So basically, if we look at the value, or should we say the pricing there, it's despite, if you look at the disparity in the pricing to where it's been, the inflows being generated, or the yield and being generated by the token, are already where they were at previous all-time high.
Absolutely.
But that's not been reflected in the price.
Absolutely. It's a more profitable business. They have expanded in new chains, and it's a leader, and it's a bargain. And it's not, again, it's not a recommendation. We're not in the business of picking tokens, but it's an example of the potential that the sector has and some fundamentally undervalued tokens have. It's not an immediate call to action to buy the token, but it shows that the upside potential is there fundamentally. Same thing for DEX, decentralized. It's another subsector of DeFi. Decentralized exchanges are essentially competitors of traditional trading platforms. They just have all the trading activity on chain. And as you can see, so Uniswap is a leader, but as you can see, in total, the sector the sector activity metrics have reverted to the previous cycle high. So a very healthy increase compared to 2023, 2022. Uniswap, which is the number one in the sector, has generated $4 billion in fees since inception. Again, at least it was only 3 years ago that the protocol started to generate meaningful fees. And it's 50% of its current fully diluted valuation. So I don't know what you think, Kev, but it looked to me like, I wouldn't say a Warren Buffett investment, but a lot of value is being created.
Yeah, definitely seems the case. So certainly, I think, oh, there we go. The same chart again as before, showing you that pricing wise, it hasn't caught up with the fact that the yield and income being generated and revenues being generated is at all-time high, but the pricing is far off it. So definitely it screams of an opportunity anyway. So I guess it's clear, Yanis, that there is value in the market and there is so much more than just Bitcoin. But at the moment, only Bitcoin and Ethereum have ETFs. And I do say at the moment because we will see the rest coming and applications are in, I'm sure, for the likes of Solana and XRP and a whole host of other digital assets. But most altcoins are listed on exchanges, but exchanges can be difficult for certain people to get onto, to register and to use. And many small caps are not yet listed on exchanges. So a question for you is, how can investors gain exposure to these low cap digital assets or the small cap digital assets and find these undervalued winners, if you like?
I think the best approach, but I'm not going to say otherwise, is to invest in a proven fund of fund strategy. Our job is to actually select the best in class funds investing in those sectors. And you won't find any ETP, ETF, or product investing in those undervalued altcoins in the broader market. And this is, I mean, if you want, our fund has 4 main strategies. The first one is as you can see on the left hand side, the first main strategy that we have is fixed income. We invest in lending staking funds, generating a stable return in the low single-digit return. It's, extremely undervalued at the moment. We have only 1% in the portfolio. Why that? Because we believe that 15% is not enough. We can 3x, 4x over the next 12 to 15 months. Then we have, but this strategy is going to be very useful when we lock the gains and we reallocate to stable returns during the next bear market. But in the meantime, we haven't yet experienced the broader market expansion, and this is why we focus on the other strategies. The second one is beta passive strategies. This is the light blue. The light blue color in the pie chart, 24%. So we invest in trackers in Bitcoin, Ethereum, and we are above all invested in altcoin trackers, investing in Solana and the big cap altcoins. Then we have the third strategy. This is the orange color, and those are trading funds actively managed using different approaches to invest select tokens, and they're going to invest in mid cap to small cap tokens. You can find a few names here. The idea is that they're really able to expand their investment universe and focus on maybe hidden gems, which are going to be ranked 80 in terms of market cap, and maybe tomorrow they will be ranked. Those will be a top 10 token. We don't know, but they know, and they have teams on the ground. They have a proven track record of doing this, and we actually count on them to deliver those returns because the market environment is going to be supportive. Then we have the fourth and final main strategy, which is the dark blue strategy, which is the PE, private equity venture capital. Those are
Just on that, Yanis, for the sake that there has been a question that came in just asking, and what is PVC and what type of venture capital? So this is a great chance for you just to expand on that.
sure. Thanks for the question. So PVC stands for obviously private equity venture capital. Those are hybrid funds with a low liquidity, but able to invest in projects which are not yet traded. And the point here is that you might have heard those discussions and sometimes criticism about tokens being launched at crazy sky high valuations on the market. Those typically are the funds investing in at early stage and being able to do a juicy exits when the bull market matures and the liquidity is there to buy those tokens. So we expect a lot from those funds, and typically they perform the best in the third year of the cycle. Typically, the moment now where we are, the period we are entering now. You don't see names because they don't invest in tokens or in those tokens which are liquid, but they are. Historically this has been the most profitable strategy, and because of that, as you can see, blockchain strategies funds in the life cycle at this moment of the cycle managed to achieve a 573% return between October 2020 and November 2021. So we doubled Bitcoin 300%. All this to say that it's not just a theory. It's just that when you invest in the broader market with the right funds, and indeed you have market growth, market expansion, we are, I think, the right recovery play, the right fund to participate in this expansion. And this is a quick overview of the fund we have in portfolio. We're not going to go into details, but as you can see, we have highlighted the funds which invest in the broader market with exposure to the recovery in the broader market that we envision at this time, and very happy to be more specific in separate meetings. But we are very invested in altcoins and those funds. Not only that, we have Bitcoin and Ethereum, of course, but we are really overweighted in those sectors. And maybe as an example of how profitable this can be, this is a capture from our portfolio management system. You can see the chart here showing one of the funds we have in portfolio, and the performance, the real performance audited track record achieved by this fund during the last alt season. As you can see, it's really an exponential growth, and we believe that typically with those funds we cannot perform. Well, I don't know if we'll be able to 10x, 5x, or 4x, but we know that we greatly outperform the market and Bitcoin as a result.
Okay, Yanis, I've just been advised that the last two screens, they weren't showing when you were presenting. They couldn't see those actual screens.
Oh.
Is your screen still sharing? And could you just pop back one
This
more?
one?
And pop back one more. And again, just go back again to the overall strategy.
Yes.
You appear when it's gone on to this screen. Next one back here. From this point, I'm not sure that the presentation was showing. It was only your face. I've had some feedback.
My face is not interesting here. The slide is more interesting.
Yeah. Okay. So is that slide now? Sorry, I'm just on to somebody now. Is that, if anyone could just give me an indication now that they are indeed seeing the presentation.
I can see it.
Okay. Perfect. So this is where we're talking now about. Earlier on, we were talking about the different sectors, the different strategies, whether it be the fixed income, the better passive, your quantitative, systematic, fundamental. They fall within the trading categories, and then the private equity and venture capital. And we see here a number of of projects and a number of tokens that predominantly through the trading sector and particularly through the private equity and venture capital funds, they provide access to a lot of these tokens. So you'll see we do have Bitcoin and Ethereum, which and Solana. The large caps feature a lot in the trading funds that we have allocated to. However, as Yanis rightly adhered to, the private equity and venture capital funds, for them, they are investing in the unicorns of tomorrow. They were investing in DeFi before we really knew what DeFi was and before it became mainstream. So we don't really have an exhaustive list there of what they're allocating to, because many of the tokens and projects that they're invested in really early stage and seed stage, they haven't even made it to exchange it yet. So this is where they look to generate their 20x, 50x, 100x on these unicorns of tomorrow. That the research team that they have and the capital that they have to deploy means they get in at great discounts and with great terms and very, very early. So I just don't think that screen came up, Yanis. So if we can move on from there. I think you did cover most of them though. The next screen I think we covered. And it was just here. So sorry, Yanis, if you just want to go back here to the previous screen, just on this one, gents and ladies and gentlemen, this is a great example here of the kind of returns that we look to try and identify, that the funds in the venture capital space they're very much out of scope for most investors. Funds like this that basically, due to their extremely high barrier to entry, typically $1 million. One fund that we allocate to is $5 million minimum investment. It means they're out of scope for most investors. So through BAM and the fact that we do provide exposure to these funds, it gives investors the benefit of being exposed or receiving the exposure to these funds, which offer a level of stability, security, and of course returns that are typically reserved for institutional investors. So these funds tend to have $1 billion AUM, the best research teams, deal sourcing teams to be able to take advantage of the market and to do the deep dive research to make sure that they are investing in the unicorns of tomorrow that are typically out of scope for most investors. So this is where they're capable of delivering, as Yanis said earlier, in the third year of the 4-year track. So where we are now, sitting going into the post-halving year when the market really rallies, these are the funds that tend to really outperform. So yeah, that's a good point on there. I think we've on the last slide, Yanis, because we're coming to an end. And if anyone does have any questions, they are welcome. Although what I would like to state is that we would love to have the opportunity to have one-to-one calls with anybody that is interested and would like to have further information. The one-to-one calls are much better. We jump at the chance, so you can email myself, kballard@blockassetmanagement.com, or Yanis, which is George Andelis @blockassetmanagement.com, or you can fire the questions to info@blockassetmanagement.com, and we'll be happy to arrange a one-to-one call for you. It's much more personable, and I think you'll get more out of it. But before I run through a brief summary here, if there are any questions, fire away and we'll spend a couple of minutes looking at them in a moment. But it's just to close, it really leaves me to say thank you, Yanis, for the overview. Here is just, sort of a recap for you of sorry, Yanis, if you just keep that screen on, I'll just use it as a recap. So basically just to reiterate that very much the time is now. Block Asset Management believe that, now is the time to invest in the market, but not just Bitcoin. We're not going to knock Bitcoin as an investment, and we have a good allocation within the portfolio to Bitcoin. But the time is really now to diversify into the broader market. The Blockchain Strategies Fund provides exposure to some of the most reputable crypto, private equity, and venture capital funds, as we previously just discussed, typically out of scope for retail investors and reserved only for the institutional and ultra high net worth. And the Blockchain Strategies Fund basically provides a diversified strategic investment that is well positioned to capture the imminent bull run in the digital assets market. So I'll just, if you shut this page down, Yanis, I'll go to questions and just see if there are any there. As I said, I would prefer to have questions directly and host some calls directly with anybody that would like a call. Let's have a look here. So perfect, thank you. the PE and VC, do you have a more detailed information to see specifically which company are we investing? Yeah, I can take that one on board. So basically, we can typically, the funds that we invest in, we tend not to give a complete disclosure of every fund that we invest in because, first of all, it's our Coca-Cola recipe. It takes us approximately 3 months for any one fund to go through our due diligence process and our DDQ, which includes visits to see the fund. So there's a large cost implication on a fund getting right through our DD process and making it into our portfolio. But what I am happy to say is with the venture capital and private equity funds, given the high barrier to entry, it is unlikely that any of our potential investors are going to decide to invest or capable of investing directly into those products. So they're names like Pantera, names like Brevin Howard and Multicoin Capital. So they are the biggest 3 venture capital funds that exist in the space. They have a great track record. They have extremely high AUM, and the research teams have proved that they can deliver in this market. So, during the bull market cycles, the returns that these funds have delivered in the past have been exceptional. So these are the kind of funds that we are investing in. They are purely crypto venture capital funds. Some of them also have a little bit of trading on the side, but predominantly they are venture capitals. And it's worth noting another advantage that Block Asset Management and our fund provide to our investor network is that these funds typically come with a lock-in period of between 12 months and 36 months. So typically going into these venture capital funds, you would have a up to 3 year lock-in period where your money is illiquid. You cannot redeem from those funds. As a fund of funds, as we allocated early at the very start of our journey, and as we are regular allocators, as and when our inflow grows, we've been able to have some benefits. So side letters, if you like, that our bite sizes or our investment levels can be slightly below what would be the typical minimums of 1 million US. Our bite sizes can be slightly lower. And also the lock-in period of 12, 24, 36 months has been waived in order to receive and meet our requirements of going into our fund of funds. So we would have a separate liquidity terms, typically of 90 days notice, which means our portfolio, when you see our portfolio construction, we are very limited and we have very strict weighting controls to how much of our portfolio we can allocate to venture capital and private equity to ensure that our fund meets our monthly dealing, monthly redemption terms. We ensure that 70% of our portfolio, approximately, can be liquid with 1 month's notice to meet our redemption terms. The 30% that isn't is our allocation and exposure to the venture capital funds, which would be a 90-day notice to get out. So again, that's just to answer that question on the types of funds that we have in the venture capital space. I don't think there's any other questions there. So I'd just like to say thank you to everybody for attending. Yeah, there's no open questions. If anybody would like a recording, please let us know. We'll happily send that out. And if anybody would like a one-to-one meeting to speak to Yanis, myself, or anybody at the team about what we do at Block Asset Management, about our fund strategy and our expectations going forward, please let me know. And if you're not on our monthly distribution list to receive our market analysis and our fact sheet every month, please drop myself, Yanis, or the info@Block Asset Management a quick email providing your details, and we'll add you to our list. So, Yanis, thank you very much for your time. To the attendees, thank you very much, and we hope to speak to you again soon. Thank you. Bye-bye.
Bye-bye.